On behalf of the Fuqua School of Business, I'd like to welcome all alumni to today's first ever live forum for the Fuqua Faculty Conversations. My name is Shane DeColly. I'm an Associate Professor of Accounting at the Fuqua School, and joining me today is Ted Getton, who is a second-year MBA student in the daytime program. And what Ted will be doing is checking the live Twitter feed for any questions that you may have during this session. You can submit questions via Twitter using the #FuquaAlumni hashtag. That's #FuquaAlumni. And Ted will be processing that Twitter feed and asking questions as we go along. There have been some questions that have been submitted prior to the live forum today, and I've had a chance to go through those, and I have some comments on those that I'll share initially, and then we'll go to the Twitter feed. If you have any technical issues at all with your computer, then you should contact Fuqua's Technical Support Centre on 919-660-7878, and you can also email help@fuqua.duke.edu. Okay, so moving to the questions for today. The first one comes from Patrick Jordan, who's a Wemba 2002 graduate. And Patrick asks the following: the CEO role is critical in establishing organisational behaviours, which also drives financial performance. Can you comment on the CEO attributes that enable her executive team to be more successful in complementing her style? Also, can you comment on the CEO's impact on the overall company culture in large versus small firms? Firstly, I would point out that I don't think academic research yet has developed a rigorous set of attributes that allow the executive team to complement the CEO's style. There are many attributes that apparently matter that we've seen from prior research, as you saw from the video, but there's no conclusive reasons other than some psychology-based reasons as to why they matter. And I think there's just a lot more research to be done in the area. That said, there's been a little bit of exploratory research which I've had the fortune to be able to participate in that's been done with KRW International. They have a very extensive survey that they use, and I mentioned it again in the video. And in that survey, they find that there's at least 4 types of attributes that seem to matter a lot. And those attributes are integrity, first up. Secondly, responsibility. Thirdly, forgiveness. And fourthly, compassion. And those sorts of attributes are discussed in much more detail, and what they found with respect to those attributes and the subsequent economic consequences of those attributes in a book which is entitled Moral Intelligence. And this book is written by Fred Keel, who's is the founder of KRW International, and also co-written with Doug Lennox. And it's a book I recommend to the MBA students, and I think it's a really nice discussion of the effects of different types of attributes. In a small sample, they don't have a lot of observations at the moment, but it's continuing to build, and it's fascinating data. Now, full disclosure, I don't have any financial interest in the book whatsoever. I just wanted to point that out as additional reading for anyone that's interested. In respect of large versus small firms, I don't know this for certain, but I suspect that integrity will matter more for large versus small firms. And the reason why is that there's more complexities in large firms. There's more opportunities for CEOs to extract private benefits potentially. And because of that, there needs to be some type of mechanism that mitigates that potential. And I believe that integrity is, along with other CEO attributes, helps to mitigate the potential for things like earnings management, tax avoidance, and other such types of economic consequences. So the second question that was submitted, or second set of questions, come from Lynn Kay, who's a daytime 1982 graduate. The first question was from Lynn was, what was the universe of CEOs whose integrity we study. And I can tell you that the universe of CEOs in the large sample paper came from publicly traded CEOs from 1995 to 1999. Now that seems like an odd period, but it turns out that that particular period was the best period for accessing the data. It's not easily accessible, shareholder letters, electronically. And so we started with 95 to 99. The results are very strong there in that sample. We've also started gathering data from much more recent samples, starting in 2005. And so far, we haven't seen any differences in the types of outcomes. We're also accessed the KRW international data, which has a selection of 56 CEOs, at least what we've got at the moment, but it's now gone up to about 85 CEOs that they have. And these are all clients of KRW, and they represent public, private, and non-profit organisations. The second question from Lynn relates to how does it vary, based on your findings, how would you characterise the average level, the current average level of CEO integrity? And I would say that the average level is difficult to classify because we don't really have a benchmark for assessing what's the optimal level of integrity. My suspicion is that as screening tools and mechanisms and as academic research tools become more pervasive in practice, we will see that and also as regulation becomes more constraining, the level of integrity that we will observe in CEOs who are employed in large organisations will be higher over time. And I just think that these screening mechanisms are starting to identify the types of CEOs that have the levels of integrity that the firm needs for their contextual situations. The third question from Lynn was, how does integrity vary among sectors of firms in our study? And I can tell you that we haven't had a chance yet to see how integrity varies across different types of industries, but I expect that integrity will matter more in complex and large firms and in industries that do not generate a lot of publicly accessible information, such as firms that don't have a lot of analyst followings. And we haven't done the cross-sectional cuts in our data yet, but I suspect that the reason why we will see that integrity matter more in these large and complex firms as well as firms where there's not a lot of information is that integrity is going to matter more when people aren't watching as much. So in other words, when there's not as much monitoring. And I think there's some evidence that is starting to come through. An example is the Hunton, Hoytash and Thibodeau paper. And they have a paper that's looking at the tone at the top, the perceived tone at the top of the organisation and how it's associated with things like earnings quality. And as you might expect is that when there's a positive tone at the top, then we see a positive correlation with the quality of earnings. But a very interesting result in their study as well is that the tone at the top is also associated with the disclosure of material weaknesses under Section 302 of Sarbanes-Oxley. And these are management-initiated disclosures as opposed to disclosures that auditors are verifying. In other words, in settings where monitoring is relatively weak, I expect that integrity will matter more. And I think the future research is going to show some more conclusive evidence on that. Okay, I'm going to move along to our third question, or set of questions, which is from Angel Gaviero, who's a daytime 2002 graduate. And the first question that was raised is, has any study done or been done over the influence in performance of the degree of alignment of the board and the CEO and of the top management team? So this goes beyond personal traits, but enters into group dynamics, and they hypothesize that it might have a greater influence than the CEO traits alone. And what I would say there is that the research that I've seen suggests that there are papers like Coles, Daniel and Naveen that measure co-option. And co-option means that when a CEO gets appointed, it's the number of directors that are appointed subsequent to the CEO's appointment. And the idea there is that a CEO tends to approve appointments to the board of directors for individuals who are connected to the CEO in some way or exhibit demographics similar to the CEO. So what Coles, Daniel and Naveen find is that as co-option increases, board monitoring decreases, and board monitoring is measured by pay for performance sensitivity, so that goes down, pay levels go up, although they don't find that wealth performance sensitivity is affected. But secondly, co-opted independent directors are not as effective as non-co-opted independent directors. So that means that if a so-called independent director is actually appointed after a new CEO is appointed, then they're likely to be influenced a lot by what the CEO thinks and therefore might not be as effective as a monitor. They also find that higher levels of co-option increases the firm risk, but that also increases the growth opportunities. So there's costs and benefits. There are certainly costs in terms of monitoring, but there are benefits in terms of the growth opportunities that the firm seems to have. It is very difficult to compare the magnitudes across different types of firms. So these group dynamics, it's hard to compare those magnitudes, and certainly between group dynamics and, say, CEO attributes, because they're just measured very, very differently. So we don't know if any differences in magnitude are because of whether the CEO's attributes truly does matter differently to group dynamics, or if there's just too much noise in each of those measures. Second question from Angel is, have you studied the following characteristics, the nationality of the CEO versus the nationality of the country, or even the percent majority nationality of the company? And he thinks that is relevant whether the CEO or the company have the same native language. The hypothesis is that cross-cultural communication and understanding might be a handicap for performance. In the research that I've seen that's been published, it's not necessarily in the top-tier journals on nationality, but of that research, it doesn't seem as though nationality does in fact make much of a difference. And I think that's partly because of the screening mechanisms that apply to the hiring of CEOs. That said, I'm not aware of any study that actually carefully considers the CEO birthplace and how it might matter. So I think that might in part depend on whether or not we can get some reasonable measures of the nationality, the language, how well they speak at the fluency, and how that might relate to the decisions that the CEO makes. So I just don't think the data is available at the moment. I can say, though, that I have worked on a study with my colleagues Scott Dyring and PhD student Dirk Black here at Fuqua, and we look at whether CEOs of these complex companies, particularly companies that have diversified across multinational borders, do those CEOs get paid more? And what we find is the answer is yes, they do get paid more. But what's interesting is that if the countries that they diversify into do not have a common language with the US, either English or Spanish, then the pay premium is not as high. So in other words, if there is some obscurity or cross-cultural communication issues, there's potential for the extraction of private benefits because it's harder to monitor the cross-cultural communications and cross-cultural decisions and actions that are taken by the CEO. And so the board recognises that when they set pay, and so the pay premium is not as high for being in a multinational diversified firm. Third question from Angel is, in terms of the top management as a group, it can be argued that there may be some difference whether the team has worked together for many years or relatively little. Is there anything on that topic? And I think the answer is yes. It's a very interesting question. I'm not sure actually what the prediction would be ex ante, because long-tenured boards might affect effectiveness of the board in terms of their monitoring, but it also could be a measure of entrenchment and whether or not the board of directors is captive in terms of the CEO influence. Same with board size. It's not clear from the literature, I think, whether having a small board, it means that there's more effective monitoring, or whether having a small board means that there is potential for the omission of information about the CEO and potentially less effective monitoring. Now, that said, there's a paper by Zajac and Westphal back in 1996, which is just a fine paper. And they look at long-tenured boards, and they're looking at whether or not these long-tenured boards tend to have more power, and they showed that it does. And what's very interesting from their paper is that long-tenured boards, or boards that have been around a long time and have worked together for a long time, tend to hire CEOs that have very similar demographics to the average demographic of the board. And I think it's a very interesting result that holds up pretty well over time. Okay, so we're now on to Greg Worster's question, which is, he's a daytime 2003 graduate, and Greg asks the following. In interviewing managing partners of the top private equity firms, most revealed that in cases where they're not hiring an exact fit for CEO of the businesses that they are buying, that they use a rigorous selection or interview process that has a scientific basis. Can you comment on the application of some of the Fuqua research in predicting the success of first-time CEOs or switching CEOs that is currently employed? My initial reaction to that is that my expectation is that the poorer the fit between the CEO and the businesses that the CEO is going to, or the poorer the expected fit, the much more likely that the firm will impose tighter monitoring. And in fact, a paper that I've worked on, for example, suggests that new CEOs, though not necessarily first-time CEOs, but new CEOs are evaluated using performance measures much more than experienced CEOs. So that's an indication that monitoring is tighter for relatively new CEOs. But an interesting cut of our data would be to look at the first-time CEOs to see if the effect is even stronger there, because our hypothesis is that when there's uncertainty about the managerial ability, there's going to be more reliance on performance measures to evaluate the quality of the CEO and how they're doing. And then outside of Fuqua, there's research by a couple of authors, Pratch and Jakubowicz, who evaluate the psychological scientific tools and finds that the tools can predict leadership quality, which in turn can help the firm generate higher returns. This particular paper is in the Journal of Private Equity, so it's specifically relevant to the private equity setting. That's Pratch and Jakubowicz. And actually, any of these papers that I'm citing, I'm happy to include a reference list for anyone that's interested in reading more. Okay, next question is from Kristen Campbell, a CCMBA of 2009, more of a comment than a question. And Kristen says that she absolutely believes that whether it be the ethics of the CEO or simply their sincere connection to the employees, there is a financial impact. I've had conversations with co-workers that after meeting both the current CEO and his predecessor, we would have done anything ethical to make the company as successful as possible. So clearly a strong connection to the CEO there. I think that I agree with that sentiment, and my reading of the KRW international data and Fred's and Doug's moral intelligence textbook would suggest very much the evidence is consistent with those sentiments. I don't know of any academic research papers that specifically measure that, but certainly the evidence that we see out in practice seems to support these predictions. So if you want to read more on that, again, I would recommend Fred and Doug's book on moral intelligence. Now, second last question relates to, or second last set of questions relates to questions that were raised by Lee Waite, who's a daytime 1983 student, or graduate, I should say. Two questions. One is, do you think that, at least in the financial services industry, legislation such as Sarbanes-Oxley and or more scrutiny on pay structures, for example, deferrals and clawbacks, have had or will have any effect? And I'll answer that question first. Certainly with respect to TARP legislation, CEO bonuses were eliminated, at least for a short time, and so yes, they've had a direct effect. But more broadly, I think there's been some very interesting research done on the effects of Sarbanes-Oxley, and I think what the research says is that there are costs and benefits. Let me start with the costs. There is a paper by Link, Netter and Yang, and they show that Sarbanes-Oxley has had an effect of reducing supply of directors for boards, increasing the demand for directors on boards because there's a demand for greater independence. It also doubles the directors and officers' insurance premiums. They also show that it increases board size and it increases director pay and director risk. And so, taken together, this paper provides some very persuasive evidence that Sarbanes-Oxley has been very, very costly in terms of the payments that firms have to make with respect to directors. On the other side, though, there seems to have been some real benefits. There's a study in the accounting literature by Cohen, Day and Lease, and they show that Sarbanes-Oxley has been associated with lower earnings management and lower levels of opportunistic behaviour from managers, which they measure via the fraction of compensation that's extracted from options. And there's been no change, though, in the earnings informativeness. So there's no negative effect on the informativeness of the earnings variable. So these benefits and costs have to be traded off, and I don't think there's a study that can make any conclusive statements about whether it's a net win-win for society as well as for the firms and the individuals involved. The second question that Lee had related to overall, directionally, do you think that American corporations get it and that the overall quality of CEO leadership in this space is improving? I do think that American corporations are well aware of the importance of screening candidates and hiring them according to predefined desirable criteria. They're also very sensitive to legislation such as Sarbanes-Oxley, as we saw in those two previous papers that I quoted. But the screening, just like academic research, has limitations, and one doesn't know whether or what would happen if sufficient temptation and opportunity to extract private benefits exists. And I'll give one anecdotal case, and I would give the example of Mark Hurd, who led an incredible turnaround at HP, but I doubt there would have been many screening mechanisms or academic research tools that could have predicted that he would one day, and these are his words, say the following: I did not live up to the standards and the principles of trust, respect and integrity that I espoused at Hewlett-Packard. And so without going into the details of what happened with Mark Hurd's exit at Hewlett-Packard, there does seem to be limitations. The point is there does seem to be limitations in the types of academic research tools and screening mechanisms that we see in practice. Finally, from Rand Mendez, Wemba 1990 graduate, question is, would the types of insights that I've been sharing on the video and today, would they hold true for divisional presidents of $2 to $5 billion in a very large, greater than $30 billion firm? So in other words, does this apply not just to CEOs but to divisional presidents? And is there any amplification of the certain impacts during the CEO transition phase, or when a CEO change occurs between two CEOs with very different traits? And which are the impacts that are more prevalent? Okay, so quite a few questions there. Firstly, I don't see any reason why these types of traits would not apply to divisional presidents. I think the fundamental differences in attributes are not necessarily exclusive to CEOs. The reason why researchers haven't investigated these at the divisional president level is I think it's pretty common to hear in academic research that the most important decision maker in the firm is the CEO, so people are much more interested in data that accesses the CEO level more so than, say, at the divisional level. At the same time, there's also not a lot of access to divisional presidents and comparable levels of divisional presidents across firms. So, for example, divisional presidents in some firms may have very different decision rights to divisional presidents in other firms, which makes comparing across firms very difficult. Then, with respect to an amplification in the CEO transition phase, I don't think that's been directly tested, but we do have some evidence that uncertainties about the characteristics of different types of CEOs or divisional presidents, or any types of manager for that matter, often mean there's tighter monitoring. And then with respect to whether or not CEO change occurs between two CEOs with very different traits, absolutely. The fixed effects literature implies that if, for example, a CEO who has traits that are associated with high levels of tax avoidance is replaced by a CEO who has traits that are not associated with high levels of tax avoidance, then you'll see the levels of tax avoidance in the firm go down. So there's very definitely fixed effects that matter, and they matter to CEOs from different organisations with different types of attributes. Finally, which impacts seem to be the most relevant? This is what I would call a horse race type of question, where we're trying to horse race which attributes matter more. And I think that's a very difficult study to execute, and that's because the measures are so noisy. In other words, if we find a measure of, for example, facial traits, and we try to look at whether or not that has a stronger effect than, say, voice pitch, then, and whether it has an effect on, say, compensation, then we may find that there's differences in magnitude, but we don't really know if those differences are due to the differences in voice pitch versus facial traits, or if it's due to the fact that voice pitch and facial traits have different levels of noise associated with measuring those types of attributes. And so it's very difficult to disentangle. So to my knowledge, there really hasn't been a paper that tries to, or a study that tries to determine who wins the horse race between different types of CEO attributes and the decisions and the effect on the decisions that they make. So that's the end of the pre-sent in email questions, and I'm going to now hand it over to Ted, who hopefully has some Twitter feed questions. Has anything come through?
We've not gotten any questions through the Twitter feed yet.
Okay, good. So do you have any questions, Ted?
Well, I do. I mean, I think that you've poured through a tremendous amount of research on this topic, and I'm wondering what research particularly surprised you, or what research you think led to some new insights that could be of value to people who are aspiring to be CEOs or are CEOs?
Yes. I actually think the Fuqua research is really interesting, and we talked a lot about it in the video. The paper I really like is the paper by John Graham and his two PhD students, Lee and Key. And that particular paper looks at whether or not these fixed effects, and it's a black box of fixed effects. They don't actually measure the types of attributes, but they are looking at switches between different types of firms and the fixed effects that go along with the CEO switches. And they look at whether or not that makes a difference to to the firm performance. And in particular, they look at whether or not the future firm performance is associated with that fixed effect that occurs after the switch. And I think what's really interesting about that study is that ability seems to matter. And it seems to matter in terms of predicting future financial performance of the firm. So any study that can predict or that can associate attributes of an individual with future firm performance in the persuasive and compelling way that they do, I think is surprising and really interesting to look at. The other paper that looks at CEO ability specifically is a paper by Demirjian and Lev and Sarah McVeigh. And that particular paper actually has an ability score, and I was just talking to Peter over the weekend. I was at a conference in Utah, and Peter tells me that he's going to be publishing those CEO ability scores at his website. He works at Emory University. And that particular paper looks at frontier analysis and looks at deviations away from a frontier, and those deviations are measured as CEO ability. And I think that they show some really convincing evidence that that's linked to all sorts of future outcomes. And so that to me is one of the more surprising papers in the literature and very interesting papers as well. In terms of what CEOs can do to change their attributes, I think the assumption in the literature at the moment is that it's very much about a fixed ability effect or fixed type of an effect. And that fixed type of effect suggests that it's difficult to change, but I think there are some things that potentially could be changed. And so I asked Bill the question of voice pitch. Can voice pitch be trained? And I think the fact that there is a market for coaches on how CEOs should respond to the media and the way that they should suggest that there are some attributes that can be trained, and I think it's very exciting to see this sort of research be done, and I'm looking forward to seeing more of it and looking at all sorts of attributes that can be measured. So I think there's really two classes of research here. There's ones where there are attributes that can be trained to some extent, such as the way that you respond to people at conference calls, for example. But there are also research that suggests that some of these attributes are fixed and cannot be changed very easily. So, for example, the height of someone, right? You really can't do much about that. But what boards of directors can do is, if things like that do seem to matter, they will tend to, maybe not consciously, but even unconsciously, be hiring people who have the sorts of demographics that and attributes that they see are important to the firm. Yeah, so I think that's all there's other studies I could talk about, but no more questions have come through?
Nothing else has come through yet, but I'm wondering if you want to touch base on something that was commented on the blog, that was the discussion of e-loading, and maybe provide a little bit more perspective on the quantitative measurement that these studies have relied on.
Yes. So e-loading was a measure that was used in the study that Thomas Steffen and Bill May and I have worked on, and it's the primary measure of earnings quality that we do. And e-loading is a measure that comes out of a study that was done by several authors at Fuqua. And it's a returns-based representation of the effect of earnings quality. So they look at, I'll start with the three-factor model of the prediction of returns. So they look at the traditional characteristics, or the traditional three factors out of the finance literature, and then they add to that this accruals quality measure, and they look at the returns responses to that accruals quality measure. And the idea there is that the sensitivity of the stock price to accruals quality yields a measure of the earnings quality, and it's a market-based measure of the earnings quality that's associated with each firm's earnings disclosures. And so it's a very powerful measure. It's very robust. It works in many different settings, and thankfully it works in our setting as well for our integrity project. And actually yesterday Thomas had written to me to say that he's done some further work on the integrity measure, and the interesting thing that he's done is that he's also been able to extract management disclosure and analyses from the 10K reports, and he correlates the information that comes out of the MD&A with the information that comes out of shareholder letters, and the common correlation between those two types of reports he then identifies as a separate variable, and then whatever's left over when you regress the shareholder letter information on the MD&A information, so in other words the residual from that regression, is also included as a variable in the e-loading regressions. And what's very interesting is that the common correlation does not predict e-loading at all, but the correlation that's unique to the shareholder letters, which is, we claim in our paper, is much more personal, is written by the CEO, is less regulated by lawyers. That sort of residual correlation that's unique to the shareholder letters drives the result that that earnings quality is affected. So when I say the correlation, it's related to the causation word. So what Thomas does is that he measures causation words in MD&As, he measures causation words in shareholder letters, and the information that comes out of causation words in the shareholder letters that's unique to the shareholder letters is really what drives that result that e-loading is affected. So it's a really neat result that we were hoping we would find, and we've just been able to download all the data and be able to confirm that finding just in the last day or so. So it's an ongoing work in process, and we're looking forward to developing it further.
Very, very interesting. Wondering, when you were speaking of this, and in the last webinar, so many of our faculty members appear to be really focused on integrity of business leaders. And it's interesting how in one institution you have so many people doing research on a similar subject but from different angles.
Yes.
What kind of collaboration do the professors, especially in our accounting department, have with each other, taking the same subject from very different angles? That's
a great question. So when I first started putting together the video, the Fuqua Faculty Conversations video, I knew I wanted to do something on CEO traits because I was particularly interested in this integrity project, but I felt that it was important to be able to show what's in the literature so far, and to make the point that academic research is measuring these types of traits. And as it turns out, I didn't have to look very far to be able to find researchers from Fuqua working on these types of studies. And in the finance area, there is a lot of collaboration. So for example, the paper on facial traits has John Graham, Cam Harvey, and Manju Puri. The paper on CEO ability measured through fixed effects of compensation has John Graham with 2 PhD students. The paper on overconfidence has Manju Puri and David Robinson. And then there are others there as well. But then in the accounting literature, or the accounting area at Fuqua. Bill Mayu and Mohan Venkatachalam are working on the voice pitch literature, and they have at least 4 papers that are published in top-tier journals and that are highly regarded, that look at how voice pitch matters. And in fact, they have a 5th paper, I should say, that looks at particularly the effect of voice pitch on compensation, and they're showing that it matters in managerial labour markets too. And so they started with the idea of voice pitch, and they've got this software that identifies voice pitch, and they're applying it in many different settings and generating several different research papers that shows just how voice pitch does matter. And in fact, they've got this very unique data set that's available to them at the moment as they publish these papers. But my understanding is that at some point they're going to start to release these types of voice pitch numbers on publicly available websites that hopefully will be of benefit to practice as well. So I think that's a ways away, but I do know that they're working carefully on that. Now, with respect to things like CEO tenure and the effects of CEO tenure, I'm working on a paper with Bill Mayu, as well as a former Fuqua faculty member who's now at the University of Miami, DJ Nanda, looking at the role of CEO tenure and whether that proxies for the uncertainty about ability. So the longer that a CEO has been with a firm, the more experienced they become with a specific firm, the less uncertainty there is about that person's ability. And when we show how that matters in terms of the reliance and performance measures. I'm also working on a paper with Thomas and Bill, of course, on integrity. And then I'm also working on a paper that looks at the effect of CEO complexity on pay, and importantly, whether there are certain types of attributes that affect that relation between CEO complexity and pay. And I'm working on that paper with Scott Dyring and Dirk Black, who's a PhD student. Scott's an associate professor here at Fuqua. And that particular paper shows that the pay for complexity relation tends to be weaker when there are certain types of attributes in place. For example, the CEO's expands into countries that don't have a common language with the US. The CEO chooses to go into countries that have relatively, that are known to be tax havens, or the CEO chooses to expand into countries that have a low rule of law, or potentially have very strong cultural differences with the US. So there's lots of research that I think has been more serendipitous rather than planned out in terms of the types of questions to ask. It just so happens that Fuqua seems to be pretty much a hotbed at the moment for research on CEO traits.
Very, very exciting stuff. Building upon the discussion of CEO diversity and how that might play a role, we have a question from Andrea Muhammad, and she asks, have you seen how gender affects CEO traits in the research that you've reviewed?
Oh, I know Andrea. She's a MBA 2008 graduate and works with, does some fine work with Fuqua now. Now, gender does seem to matter. I don't know a lot about that particular literature just because that's not something that has come up as a control variable or a specific variable of interest that I've looked at in my work, but I could quite easily later identify several papers that look at the effect of gender. In fact, I think there was one recently that shows that the gender of the board makes a difference to monitoring outcomes. And I know that paper was published in the Journal of Accounting and Economics, and I can't remember who the authors are, but I'd be happy to describe a little bit about that in the blog later. So yes, I believe that gender does matter. It's important.
Great. I've got a follow-up. It's a little bit appropriate considering we're using Twitter as a method for asking questions. That a lot of the research that you've looked at has been constrained to certain times because that's what's the data that's available.
Yes.
Has there been research that's looked over how CEO behavior and traits have changed over time? And then when do you think we can expect to see some research that takes into consideration that now CEOs are communicating using tools like Twitter, speaking directly to people via YouTube and other methods, not just the quarterly earnings calls?
Yeah, that's a great question. I think that, so two parts. The first part is, does it matter, or does CEO attributes change over time? And I think that, getting back to a point that I made earlier, I think that the more sophisticated these tools for screening CEOs become, then the more likely we'll see CEOs be matched with firms, and those CEOs will have relatively high levels of attributes compared to what they were, say, I don't know, 20 years ago. And again, there's no evidence on that yet, but I think that's coming. And an interesting finding, a really interesting finding of the paper by Francis, Rajgopal, Amy Zhang, and Alan Huang, who, again, 2 faculty members at the time and at Fuqua and 2 Fuqua PhD students. Really interesting part of their work was that they found that there was a matching story going on. So the CEOs that had the highest reputations, as measured by press citations, were associated with firms that tended to have poor earnings quality, and that's just because they found that there was a matching going on. So the firms that tended to have poor earnings quality tried to hire CEOs that have very high reputations so that they could share and get noticed in the press information about the firm through voluntary disclosures. The second part of your question, Ted, related to the use of Twitter by CEOs. And one thing that's very interesting, one of the things that I do outside of Fuqua actually is I'm asked to mentor high school students, and a high school student from the School of North Carolina School of Science and Maths came to me and asked if I would supervise a project or mentor a project. And so I suggested that she look at whether CEOs tweet. And in fact, the more relevant question is, why do CEOs tweet? And what she did was she accessed the 50 highest tweeters, or CEO tweeters, is that the right word, tweeters? Yeah. Mm-hmm. And downloaded all of their tweets that were available on Twitter at a particular point in time. And she found some really interesting descriptive statistics. And one of the things that she found was that a lot of the tweets that come from CEOs are actually tweets that are company specific and nothing to do with the CEO. And there are other CEOs that do tweet very personal things. And what would be interesting is to show whether or not the CEOs that have personal tweets have an association with outcomes that are different to the CEOs that rely predominantly on company-driven tweets. So that's a really fascinating little study that sort of evolved into something much more than we expected it to. And it's in line with some research that's been done out of the University of Michigan by Hal White and Greg Miller. And they've got a third author that his name escapes me at the moment, but it might be Brian Miller actually. But their paper shows that the type of CEO tweeting activity and the level of CEO tweets for a much broader sample of firms tends to be associated with returns outcomes. And it's a paper that I was actually talking to Hal over the weekend at the conference as well, and Hal was telling me that they find some really interesting results which they think are persuasive. They've done a lot of robustness tests, and the issue that they face is that there are people that do not really understand what the tweets are actually capturing, whether there's new information in there, and they do have a lot of controls in their study, and they do show that over and above those controls, the information in these tweets seem to matter in terms of stock prices, but it's hard to convince people that the information in tweets is not already out there in some other form. And so they're still working to get that one published, but it's a very interesting study. And again, I'll be happy to, for anyone that's interested in whether CEO tweeting matters, I'd be happy to share that in terms of a link to the working paper.
Could probably have a lengthy discussion on the impact of Twitter on financial markets as folks are increasingly using that to do research.
Absolutely.
We have a question that's come through the Duke Fuqua account that's from a 2008 alum. And the question is, can you elaborate on the use of causation words in shareholder letters?
Yes. So Thomas Stephan is in the background here with me as well in case I misspeak. But the number of causation words comes out of a dictionary of words that's been developed by online, and I think there's about 108 words, is that right? Causation words that are things like because and related to excuses. And those 108 words are captured in shareholder letters, are measured in shareholder letters, so we literally count them, not manually. There's electronic processes, of course, for doing that. And then the percentage of these causation words relative to the percentage of other words in the shareholder letter is used as the score for integrity. And it's a very simple measure. It takes some work to actually get the measure, but it's a simple, and what we are learning more and more about is that it's very, very powerful as well. And to give you an anecdote, Warren Buffett shared his shareholder letter, or gave his shareholder letter just this past weekend in Omaha, and I asked Thomas to see if he could run the effect of the causation score on the shareholder letter that Warren Buffett just released. And it turns out that he talked a lot about things that had happened during the year that he believed were mistakes on his part. And what was very interesting about the way that he discussed his mistakes is that he just openly admitted them, and he, consistent with the definition of integrity, he was very upfront and gave the information and conceded that he had made some mistakes. And so when Thomas ran the causation score through that shareholder letter, he found that the causation score was in the bottom, I think it was 10%, was it? The 10 to 15% of the causation scores, which means that he was in the top 10 to 15% of integrity as we would measure it. And so we thought that was a nice validation of our integrity score. So a sample of one, of course, but it's consistent with what I think Warren Buffett's general reputation is that he's a man of integrity, and our measure seems to support that. Another example at the other end is within our sample, we know we've got at least a few CEOs who are CEOs of companies who had to restate their financial numbers because of inappropriate or misstated numbers that were originally reported. And it turns out that those types of CEOs consistently have fairly high causation scores. In other words, would score relative low integrity on our scale. And I'm not going to mention the names here, but there are certainly many examples that are in the data that Thomas has developed that are consistent with the idea that integrity matters, and it seems to be associated with predictable outcomes.
Great. We have one quick follow-up before we wrap up, sure. And it's that do we think that CEOs will be more careful in the future with use of causation words in the same way that perhaps somebody might hire a vocal quality coach?
Yes, I do believe so. I think that if it turns out that our research really takes off here and makes an impact on practice, then I suspect that we will see more reviewing of shareholder letters in the future, which of course doesn't help us because then we're not able to disentangle the low integrity from the high integrity if everyone has low causation. However, we can say something about integrity at the moment based on these causation scores, and it just means that academic researchers will have to find new ways to measure integrity, and I think there's lots of potential opportunities. Now, yeah, so the causation scores, they may be filtered out with more reviewing, maybe by legal departments, for example, just as they do with the MD&A. And at the moment, we've talked to several people that are in investor relations, and our understanding is that the shareholder letter is much less scrutinised than what the MD&A is. So it'll be interesting to see going forward what will happen. I think we've come to the end of our time, unfortunately, today. I've very much enjoyed it. It's always great to talk about research. I'd like to thank everyone for attending the session today, and let you know that you can still submit comments or questions after the event at the website below the videos in the comment box. You can comment directly, and I'll try to respond the best I can. And I just want to say that the next presenter, faculty presenter, will be Cam Harvey, who is the Professor of International Business and the founding director of the Duke CFO Survey, and he'll be featured in April 2012. So he'll have a video 1 week, and then the following week he will have a live session where he will take your questions, and more information on that will be coming soon at the website. For now, I'd like to say thank you again and sign off. I'd like to thank particularly Jason, Matthew, Thomas Stephan for coming in, Aaron, Jacob and Katie, as well as Ted Getton, who's off to Apple computers, and they've made a fine hire in my opinion. And thank you all again for coming along to the session today.